Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another Barometer Readings webcast. Tonight, I'm joined by David Burrows, our Chief Investment Officer and Chief Executive Officer here at Barometer Capital. And joining us as well is our Associate Portfolio Manager, James Callahan, who will be waiting to provide us a little bit of an update on NVIDIA and Broadcom as they're due to report at 4:20 this afternoon. So hopefully we can get some insight from James. It is a key holding at Barometer, so look forward to that update. We will provide you with a brief macro overview this afternoon, and of course, be pleased to address your questions at the tail end of the conversation. So feel free to ask your questions in the Q&A or the chat via Zoom. And with that, on this lovely 21st of November, I turn the conversation over to our one and only David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Great. So nice to see you and be back here on the webcast.
Well, it's great to have you here. It's great to have James on. We're going to put James on the hot seat tonight. As it turns out, NVIDIA, about the biggest position in the firm, and they're reporting this evening. So obviously, we do think that there's a great case to be made for NVIDIA, but we're always subject to noise. So it'll be interesting to see how they report tonight, how the market responds off the bat, and get some color from James. Of course, it's been a very, very good 2.5 weeks for equities. As I always say, in the middle of October, lots of interesting conversations with clients. People obviously get concerned about what's going on seasonally. And we thought that there were signs that this was more of a seasonal sort of annual correction than something bigger. We obviously have had 2.5 weeks where markets have had a very substantial rally. We've had all kinds of signaling we've talked about on these webcasts. And so as always, I want to just start from the top and just take a look sort of from a bird's eye view. Our view is that ultimately our portfolios need to be aligned with what is actually happening in the market. We are never going to say we're right, the market's wrong. So we do these webcasts partly to be transparent about what it is that we're doing in portfolios, and partly to test our theories to see if something is changing, if something needs to change in portfolios, see if there's new leadership or old leadership receding. Our base case has been now since 2013, we're in a structural bull market for stocks. That's when we exceeded the high from 2000. We exited a secular bear market. And not to say you couldn't make money during a secular bear market, but the declines are much steeper and the advances don't last as long. So it's more like one step forward, one step back. It was that way all the way through the 60s and 70s. It was that way through the 1930s and 40s. And by the time you get to a secular bull market, people are very prepared to say it's over. Why would I want to own that asset class? And people get dragged in kicking and screaming. So this has been going on now a decade. They tend to go on 15 to 18 years. There are lots of interruptions along the way. This one has been no different than any other. We've been going through a 23-month bear market / correction since January of 2022. We're still about 5% off the highs. I think there have been lots of people who made the case for why this is going to be different, why this was going to be more like a bear market and a structural bear market, like the tech wreck in 2001, 2, and 3, or like the financial crisis 2007, 8, 9. We thought that this looked nothing like that. And I think that is the case. We're now getting very close to exiting this period. And what's exciting about that is in a structural bull market, when you make an exit, you tend to get a long, prolonged advance. And that tends to be driven by a bunch of things. People starting to look over the valley of maybe an economic slowdown, or in this case, maybe a Fed tightening cycle. People start to look at their positioning and say, maybe I need to be positioned differently. And as money gets brought to bear on the market, prices rise. So our job is to be there early on and have money come in behind us. We know that as of 2.5 weeks ago, positioning was exceedingly defensive with very significant cash weights on the sideline. We know that sentiment was exceedingly bearish, probably more bearish than any time going back to the 2009 financial crisis. We know lots of concerns about geopolitical risks in the market. But at the same time, lots of positives on the other side, is that we like to say the market's like a great big machine with 1,000 moving parts. There's some very obvious pieces that you can see moving, but very often under the surface, there's a lot more going on. And so our job is to try and understand what's actually happening in the market. So when we look at the S&P, we know that on October 31st, our short-term indicators turned higher, and on November the 2nd, our long-term indicators turned higher. And boy, what a rally we've seen since then. Of course, that's forced us to put a little bit of money to work that was on the sidelines, so that's fine. Half our job is to make money, half our job is not to give it back. So the market has been working its way through a series of higher lows going back to October of 2022. And a couple of things that we think have been important. First of all, that the very strong run-up in the US dollar that we saw all the way through the summer came sort of to an overbought level back in the middle of October, and started to show some weakness. And that run up, as it started to wane, you can see the relative strength of the dollar started to fall, and that took the pressure off of risk assets, much like it did in October 2022, as the run up there versus the world's currencies sort of started to wane. And we know what happened next. Market rallied very smartly. The other moving part was the pullback in yield. So when we look at 10-year treasury yields that have been rallying since March of 2020, we got a couple of times to extreme levels. First of all, in April 2021, yields started to come off, markets rallied smartly. They got to an extreme level and overbought in October of 22, started to pull back, and the market rallied nicely through into March of last year. And then once again, sharply rising rates again, got to a point where the fear created some fear in bond investors. But we saw again an overbought condition, but even more important, a divergence where the strength in the rally was less strong than the last one. And in fact, while yields went to a higher high, stock market did not go to a lower low. It held at higher levels. And since over the last 4 weeks, we've seen stocks rally nicely. So dollar a little more friendly, yields a little bit more friendly, stocks behaving a little bit better. I talked about this previously. We got, very, very strong period of days where advancers significantly outnumbered declines. Had happened only a few times over history. We said, look, a month out, markets tend to be higher in almost every case. And we're in that situation today, a month later. And the most important data was 250 days out, or about one trading year out. Market was up 100% of the time and averaged 24%. We then got another signal that looked at some very strong breadth data, things that happened only 4 times in history. All 4 times marked important lows for the market. All 4 times a year out from that signal got very significant rallies. And again, it looks like we are in that case. Now, we talked about sentiment, we talked about positioning. One of the things that we like to talk about at the end of the earnings season is what happens with corporate buybacks. So we know systematic investors are in the market. Last week, we talked about the fact that commodity trading advisors and risk parity managers, both quantitative funds, had as much as $280 billion that could get put to work over the next month. So far, I think we've seen about 120. But the other very significant buyer, and probably the most significant buyer in the market, are corporations buying back their shares. Now, we know that when we go through the earnings period, most management teams are blacked out of buying back their own shares because they have material information other people don't have. So unless they have some kind of systematic program that is previously set up to be a buyer, they tend to go dark, and that creates sometimes some illiquidity. Well, one thing to point out, over the last couple of weeks, we've seen a very significant pickup in share buybacks. So there's a lot of different types of buyers in the market. There are investors who are just underpositioned. There are systematic traders that have rules that they follow. When volatility falls or breadth improves, they automatically put money to work. We're one of those. We put money to work when our breadth models turn more positive. But we also have had corporate buyers sort of way above trend in buying back shares. And that's interesting because generally companies don't do that unless they feel like things are better than the market perceives. Outside of the US, Japanese market continues to chug along. I highlight this because it's not well owned. It's certainly not well followed after a bear market that went on from 1991 to 2021, 30 years. But we do think that this is acting like an early stage secular bull market. So we think it's something worth keeping an eye on. One thing we have done over the last 2 weeks is we've moved from a currency hedged ETF to an unhedged ETF because it looks as though the Japanese yen is set to firm versus US dollar. India also having come out of a bear market in 2020 and consolidated during the Fed's tightening cycle is looking beyond that. And certainly India has been behaving better. And we talked about over the last week a change in behavior in Brazil, which is a very important global market. Been in a bear market since 2008 and only just breaking above this consolidation range recently, which caused us to put a new position on here on top of the weight that we have already on in the Latin American ETF ILF. Let's move on to bonds. Generational low in yields in 2020 certainly moved smartly higher to above 5%. If you look at the 10-year treasury yields, this was a very significant reversal that started in 2020. We broke trend in 2021 and until a month ago rallied to new highs. Now, since then, as we talked about, yields have backed off a little. It doesn't change the fact that we've seen a very, very substantial reversal in yields. So when yields go higher like this, bond prices go down. And when bond prices sell off for 3 years without making new highs, generally that's something that's very notable. If I go back to 1941 and look at the worst bear markets for bonds, they all happened during secular bear markets in bonds. So you had a secular bear market from 1953 to 1957, 35 straight months of negative returns. But that wasn't the only time. We saw in 1970s, 1972 through 76, you had 43 months of negative returns. In 1977 to 82, still during that secular bear market in bonds, where bond returns were negative for 54 straight months. So we said about a month ago, bonds looked as though they were oversold, looked as though yields were probably overbought, that they could bounce a little bit. That does not mean we're going to go push a lot of money into bonds. It's been 33 months. It may well be that these come back to break even over the next number of months. But we think if yields go down, it actually is more positive for other assets. So if we look at this last time you got a generational low in yield in the late 1940s and look at the next number of years, there were, I suppose, some opportunities where yields dropped. And maybe if you're a very nimble trader, you can make some money. But look at what happened over the period. From 1951 to 1966, bonds and inflation had the same return. So a 0% real rate of return over 15 years. And when people say it's hard for stocks to go up when interest rates are going up, well, this is interest rates going up from 1951 to 1966. Stocks went up 15.1%. But it was companies that were well suited to a little higher inflation environment. And in particular, dividend growth stocks did particularly well. So the one thing we do know is even though bonds have rallied, stocks relative to bonds are still outperforming over the last 4 weeks. So stocks making a new relative high versus bonds, which says to us, we should continue to focus on stocks. If we look at another proxy for that, dividend growth stocks versus high dividend paying stocks, we know that dividend growth stocks are continuing to outperform high dividend paying stocks. So the pressure came off high dividend stocks, and they've done a little better over the last 4 weeks, but still dividend growth stocks doing better. So our premise is that we are into higher long-term interest rates for many years to come, that there will be interruptions. But that doesn't mean that means it's a great time to go buy bonds. It means that it takes the pressure off other types of assets. Now, to just put a point on that, from October 30th until today, if we take a look, the aggregate bond index, which is across issuers and maturities, up about 3.5%. The high dividend paying cohort of stocks, the dividend aristocrats, generated total return of 5.4. The dividend growth ETF, RDVY, up 7.66. Pure stocks, the TSX up 7, equal weight S&P up 8, market cap weighted S&P up 9. Look, the opportunity is more in the equities than it is in the fixed income. Let's move on. Commodities. Commodities reversed a bear market that went on from 2008 through 2020, rallied nicely, consolidated during the Fed's tightening cycle, and is showing no sign of abating. So commodities continue to be a very attractive asset class. We talked about copper and its importance. And again, this is another asset class that finally is just breaking out of this wedge or consolidation, a tightening range that has been in going back over the last 18 months. And in this past couple of days, we started to come out of that range. So we've seen that happen in lumber. We've seen that happen in uranium. We've seen it happen in aluminum. We've seen it happen in iron ore. Now we're seeing it in copper. And these are all things that point to an economy that is not falling off a cliff. So moving on, commodity prices, once they start to outperform stocks, can do it for a long time. We think we're in very early stages now. We don't have to be everywhere. We need to pick our spots for clients. We have to have a set of rules that we follow to be able to do that. And we try to set an expectation. We think our job is pretty straightforward. Our job is to try to identify leadership in the market. What is it that is well suited to the current backdrop where we can see very clear signs that money is being put to work in those areas? In other words, we're seeing flows in. We want to be in those areas that are being positive revalued versus the rest of the market. We don't have to be everywhere. We got to use our tools to recognize change and new leadership as it emerges and old leadership as it recedes, so we can transition the holdings from time to time, keep it relevant. And then finally, in the absence of leadership, play some defense. So we know that from July the 26th through October 30th, the market went through about a 10% correction, 10.4%. We know that happens about once a year. We don't know for sure whether that's going to turn into something bigger or not. So our job is to play defense and use the stop losses that we use to manage the downside risk by position. We don't want little mistakes turn into big ones. So we are tactical. We use 3 sets of tools. We use our top-down work that helps us to identify parts of the market that are seeing net inflows of capital. And in particular, what we're looking for is areas that are seeing expanding breadth, where more and more securities are performing well. That universe may be very small or it might be very broad, depends on the market environment. Second, we use a bottom-up set of tools to help us identify securities within those groups that meet some stringent tests, in particular, that point us to securities that are good getting better. So 80% of return comes from getting to the right neighborhood, and then we need to find securities that we can use to express our view that clearly are performing relative to their peers. And then the last piece is we need a very disciplined selling strategy to carve out the positions that didn't work in the first place or that have stopped working to protect our gains. We're always looking for parts of the market where breadth is expanding. There's no bear market in history that took place in a group of stocks when breadth was expanding. So we're always looking for those areas. And when we see deterioration in breadth, that means we got to be more cautious. We stop putting on new positions. We tighten up our stops. And if we get stopped out, no new money gets put to work. Okay, so let's just talk big picture. On October the 30th, the short-term indicators, percent of stocks with the 50-day, percent of stocks with positive weekly price momentum, percent of stocks making new highs versus new lows, and percent of stocks trading above the 150-day moving average all had been weakening since mid-July. The longer-term indicators, percent of stocks in uptrends in the NYSE had fallen to a low of 28%. So that means 28% of stocks were acting just fine, but 82% of stocks were in downtrends. We don't put money to work when that's the case. On October 31st, our short-term indicators turned positive, and November the 2nd, our long-term indicators turned positive. And as we sit today, it's a very different situation. Almost 80% of companies on the NYSE have positive weekly price momentum. In other words, upward trajectory. There are more stocks making new highs versus new lows. The percent of stocks trading above their long-term moving averages now above 50%. That's the majority. And the percent of stocks in uptrends now sitting at 46%, up from 28%. So what does that mean? It means more and more stocks are performing well. It means that more and more stocks are trading above their moving averages. It doesn't mean every company is, but it means the market buying is spreading to more and more securities, and it gives us the green light to be invested. Of course, our job is to find the best companies that we can find. We need 20 to 30 names to build out a portfolio, 2.5% to 5% weightings. And it means that we can broaden out if there are sectors that qualify. When we take all of the 41 sectors that we follow and put them on a distribution curve and look at what percent of stocks are performing well, as of the 30th of October, the average sector had 24% of companies in uptrends. You can see most of them are in small letters, which means the breadth or the percent of stocks performing well had been weakening, meaning fewer and fewer holding up over time. Now let's fast forward to November 20th. As of November 20th, you can see the average sector has 37%, almost 38% of stocks in uptrends. We've moved to the right, meaning breadth is improving. Almost every sector is in capital letters, meaning that breadth is improving almost everywhere. Now, there are two notable groups that have not had breadth expanding. Insurance, which has held up quite well, but had yet to turn higher. Breadth model for insurance turned up today. And interesting, precious metals, which is a group that you would have expected to do well in a weak market, again, just turned higher as of today. So that means they become eligible for new positions. But you can see lots and lots of sectors performing well. In fact, semiconductors went from the far left column to 55% of stocks in uptrends. And this is the backdrop that we're working against coming into this week. So let's just talk a little bit about leadership. Energy has been a leadership group now going back over the last 3 years. This is relative strength versus the S&P. But you can see over the last 3 weeks, relative strength has weakened. Now, it's weakened a number of times along the way. We'll see. We don't think that this group is broken, but we're not adding anything new. Still trading better than 81% of companies that trade in the S&P over the last 52 weeks. So that's a rare company. But again, really outside of a bounce last week, needs to do a little bit more work before we'd add new positions. Uranium certainly is performing well, better than 95% of stocks, traded this week at 52-week highs. It is challenging the old highs, and companies like Cameco and NextGen are trading at new all-time highs. The reason we're here is because in general, these companies are trading at very high free cash flow yields, and there's lots of opportunity for them to grow their dividends. But again, until we see some of these stocks taking out new highs, we're not going to add new positions. Technology. Now, this is a price pattern we've talked about before. This is a cup and handle. One of the most bullish price patterns you can see. You can see that relative strength has been generally rising. And in fact, we made a new absolute high this week, and we are making new relative strength highs. So that's a great position to start from. This ETF XLK is made up of the largest of large cap growth stocks. So 3 key groups. And I'm going to ask James Callahan to jump on with us. I know he's probably dying to look at the NVIDIA numbers. This is the software ETF IGV. You can see it's made new absolute highs. It's made new relative highs. The obvious companies at the top of the list here: Microsoft, Salesforce, Adobe, and Oracle. James, maybe just give it a little thought on what you've seen going on in the software space. Obviously,
Thanks,
lots of
Dave.
news this week.
Yeah, lots of news. Software space is interesting. Our focus in the tech space had been semis, specifically NVIDIA. Obviously, the biggest weight in IGV is Microsoft, which is our second largest position across the firm. We like it. Really, it's been everything they've touched this year so far has turned to gold. Their $10 billion investment into OpenAI has turned into 49% ownership and a perpetual license on OpenAI's IP and access to their models. So a really good deal by all accounts, even though there's some noise over the weekend. And I think, like everyone, we're waiting to see where the pieces fall there. It's been interesting to see, I think, with two of the co-founders of OpenAI now having joined Microsoft, with the option to also, return back to OpenAI if the board allows it. They remain the leader. So Microsoft
James,
has locked up
they've
that
launched
advantage.
Copilot, is that right? In enterprises greater than something like 300 seats.
That's right, and so that was a huge catalyst for the stock. I think it was Q2. Microsoft announced their pricing for that product, so it was going to be Office 365 enterprise subscribers would be able to turn on Office 365 Copilot, which is an AI overlay on all of the Office products. So to think about the productivity gains you can get from using that is just wild. It'll be interesting to play around on it when the time comes and they open it up to other subscribers. To charge $30 per month incrementally on top of the highest price point Office 365 subscription that you can have, it's a big boost to revenue.
Well, certainly they had a good day when Sam Altman joined. We'll see what happens from where the pieces fall, but Microsoft has been just a great holding and made new 52-week highs as of yesterday. We also have exposure to cybersecurity. Hack as the ETF, which we own in our global portfolio. Relative strength has been rising sharply since March. I think that the largest weight we have there is Palo Alto Networks. Just touch on that just for a moment.
Yeah, so I mean, I would actually go back to Microsoft and say probably our largest exposure is Microsoft, and people forget that Microsoft is the leader in cybersecurity too. They do so much so well that you can't cut them out in cybersecurity, but another good position that we've had for a while is Palo Alto, and they've been a quick grower. They benefit from some of the positive aspects of cloud-based cybersecurity with also having an on-premise business, because some enterprises just aren't at the stage that they're willing to take something as mission critical as cybersecurity and put it in the cloud. For financial services companies, for example, there can be a requirement that they maintain on-premise servers, and Palo Alto's taken, both of those verticals, and they're a leader. So they continue to build out a good network, and they win and retain customers based on that. So they've been a quick grower, one that we like in the space.
And then just obviously to move on to semiconductors, because semiconductors just are such an important sector. It's a great tell on economic expectations, because inventory cycles are so quick. Companies do not like to inventory expensive semiconductors, and so when things harden up and orders come in, you see it immediately. When things slow down, companies have a tendency to slow down their ordering quickly, and so semis, I think, are much like copper used to be. It's sort of Dr. Semiconductor telling us where the economy is going, and we know that semis have gone very quickly back to highs. Now this is this SOXX, it's market cap weighted, so it has the biggest weightings in AMD and Broadcom and NVIDIA, the most important companies, in Intel. Get just some quick thoughts on semis, and then maybe we can touch on Broadcom and NVIDIA.
Yeah, I mean, you're absolutely right to categorize them as being cyclical. I would say this cycle was a little bit different because we've seen the benefits of continued move to cloud, and the real kicker has been AI proliferation. So when you look at the macro environment over the last year or so, I think a lot of these names would be in a worse position had we not seen the technology development and AI move so quickly, underpinned by the need for a ton of computing power. So these companies have benefited.
Well, it's interesting. I mean, we obviously spend a lot of time thinking about volatility in portfolios and where our exposures lie. We've come into this earnings tonight, with a big weight in Nvidia, and we've had Nvidia for a long time. We traded at new highs as of yesterday. There's a lot at stake here. I mean, AI is going to change how a lot of businesses do business. And we do think that this is an important company, an important space to have investment in, to protect us from some of the change that's coming, and hopefully to benefit from it. What are your thoughts here?
Yeah, to benefit from it, absolutely. So NVIDIA, maybe just to recap, is the world leader in production of GPUs, so graphic processing unit, so a type of chip that happens to be necessary for training of AI large language models, among other things. And we've owned NVIDIA over the last number of years for some of the other end markets that they serve, but this year it really has been the tale of AI. So we've been involved for a long time. As you say, it's our largest holding. To be brief, the reason to own the stock here is because the demand picture for AI chips continues to get better. The segment that they report AI chip revenue in has tripled year over year. And maybe we can get into some of the numbers. It's especially timely to talk about that company right now because they've just reported third quarter earnings. And it really, the numbers are monstrous. So just to go through some of them, expectations were for NVIDIA to do revenue of 16 billion during the quarter. They did 18.12. Data center segment, which, as I said, is the segment in which they report AI chip revenue. They did 14.5 billion versus 12.8 billion expected. And that's versus 3.8 billion in Q3 of last year. So they've more than tripled year over year. It really blows the mind. Gaming segment revenue was nice as well, but really all eyes were on revenue guidance because the stock feels well owned despite reporting such great numbers. It is trading off about 70 basis points post close. So all eyes were on revenue guidance. They guided to next quarter revenue of 20 billion against expectations for 17.8 billion. So really just monstrous numbers. It shows evidence of continued demand acceleration, which is great. That's against an environment of them unlocking supply. As the capacity that would have been used by, other types of chips, because Taiwan Semiconductor makes these AI GPUs for NVIDIA. As there's been softness in demand for other products, Taiwan Semi has given NVIDIA extra production capacity. So they've been able to meet this just ravenous demand. So we've seen supply unlock against a huge demand improvement. And, the growth has just been huge. It's funny that, the stock has worked so well, but every time they report, it gets cheaper because the growth is so strong. It really is a classic example of strength begetting more strength. So yeah. It's been a good position for us. It's been our largest position for most of the year. I think we really got involved again in the story, after some difficulties that they had last year, because as we said, it's a cyclical business. We got involved again in January across a lot of our portfolios, and it's been a core holding.
Well, James, kudos to you because I know you pushed hard on this one, and
thank you.
Certainly it's been really beneficial. Other name that we have in the group is Broadcom. Again, it's traded right back to 52-week highs, in fact 5-year highs. Any thoughts here?
Yeah, I mean, just high level, I guess, when the cloud service providers and the users of AI chips, they're buying all the compute power that they can get. So that involves NVIDIA GPUs, but companies like Google and companies like Amazon have been involved in the cloud computing space for so long that they've developed their own custom chips to provide compute specifically for the use cases they need it. And the reason why Broadcom has worked so well this year is that business. Broadcom helps them design the chips and then helps them produce these custom chips for AWS and for Google Cloud usage. And they're a beneficiary of the increased compute spend. So that's why the stock has moved. They do a lot of other stuff as well. They make a lot of components for iPhone. Actually, tomorrow they're going to close the acquisition of VMware, a large software company. So but the reason for the move in the stock has been the AI exposure.
Yeah. Well, as I say, it can be a volatile group, but it's a vitally important group, and certainly one that's driving a bunch of big industries. So we really feel that we need to be there. So thanks very much for jumping on with us, James.
Thanks, Dave.
Technology obviously continues to be an important part of our portfolios from a financial standpoint. Lots of questions about banks. We really have avoided banks. We have a big position in JP Morgan, which is behave quite differently than the rest of the banking industry. Our big exposure has been in insurance. Today, the insurance ETF put in a new all-time high. It's been particularly strong. Relative strength has been improving really since the 2020 lows in fits and starts, and has been really our focus. We've talked a lot about companies like Fairfax and Berkshire Hathaway, but we also have some alternative financial companies, and Visa would probably be the most important one. It's a top 10 position again for the firm, and relative strength continues to behave well there. Outside of financials, industrials have been a big weight for us. I keep putting this up. This is the relative strength chart of equally weighted industrials versus the equally weighted S&P 500. Interesting to see that in 2022, which of course was a bear market year, it made its relative low in May. The stock market actually didn't bottom until October. It was already relatively rallying versus the equally weighted stock market, and has just continued to do that. And we're basically at relative strength highs. Defense has been one important part, and of course, it's had a very big bid since the middle of September. But lots of different areas within industrials to support the build out of reshoring of manufacturing in the U.S. And we think that that's still relatively early stages. And of course, on the defense side, Howmet is our biggest position. It's a top 10 position in the firm. It's up almost 18% this month. They make forged parts for jet fighters and jet engines, and doing particularly well. Okay, let's just move on to materials quickly, and we'll blast through and take a look at what the portfolios look like now. I know it's a little bit longer in the tooth today. Uranium continues to act very, very well in the steel space. After a long bear market, we're getting very close to breaking out to new highs. This does not look very recessionary. Certainly, the supply chain realignment for Western-based companies is favoring U.S.-based steel companies. Forest Products broke out of a consolidation 2 weeks ago. I think that's quite interesting. We own Stella-Jones, which makes railway ties and telephone poles, and lots of money being spent on both in the infrastructure spending going on in North America. And the metals and mining ETF XME, just like copper, this week broke out upside out of the range, and we think this is one that can drive returns for a long time. I've used lots of different companies as an example. I use Rio Tinto today. This is our number 10 position in the firm. They're a producer of multiple types of metals, but this is why we own it. When you come out of a secular bear market or a period of years where the group has not performed, very often you break out and then you consolidate for one reason or another, and then the real rally begins. Between 2004 and 2008, Rio Tinto was up 521%. That was on the back of strong metal pricing and, of course, spending in the economy. Well, the bear market and commodities that went on from 2008 or 2007 through until the end of 2021 certainly impacted Rio Tinto. Rio Tinto traded in a range for many, many years, 2010 through 2021, without making a new high, and finally made a new high, consolidated during the Fed's tightening cycle, and is now just breaking out, much like it did going back to the breakout in 2004. So things don't repeat, but they often rhyme a lot. And when you have a lot of big companies within this material sector that look the same, that's not a very recessionary look. It tells you that there is demand and maybe a supply shortage. In the case of copper, we know that the Chinese stimulus is taking place. They're looking at spending a massive amount in the housing area, but we know that inventory levels are at critical low levels, and the copper smelters can't get enough concentrate to produce copper. We also know that the EV push is going to demand a lot of copper. So we think that the improvement in the copper dynamics, improvement in the iron dynamics, improvement in aluminum, all sort of push to make these stocks look very attractive. Communications continues to see relative strength improvement. That's Google and Netflix. In the home builders, a really big bump in relative strength since the market made its low in late October, getting very close to 52-week highs here. And also in the consumer, companies like Costco and Couche-Tard here in Canada, again, have traded very, very well versus the rest of the consumer space. Uber, we talked about last week. So there's a lot going on. There's a lot of very positive stuff. And that's against a backdrop of a lot of investors who are still very, very skeptical about the stock market. I get it. There's geopolitical risks. I get it that there is risk of an economic slowdown when the Fed tightens the way that they have. But investors have now had 23 months to think about this stuff and position themselves accordingly. When all of that information is out there, but some of these companies behave very differently than the rest, we have to take notice. Eli Lilly is performing well, not because the economy is strong or weak, but because there's a lot of overweight people who are going to need help with weight control. So as a firm, we continue to be very targeted. Technology, we've taken our weight up a little bit since the market lows, sitting at 18%, but still below market weight. We think that there's other things to do. We have an overweight position in financials, largely in insurance, but also in companies like Visa. When we look at the energy space, we got a little bit less because relative performance has been a little weaker. I think we took down one position, but we're still a significant overweight. In the bigger scheme of things, we think energy continues to look very attractive. I mentioned on the corporate bond piece, we took some of our cash, we bought 3-year bonds. We have some portfolios that have to own bonds. And for those, we moved our exposure out from 1 year to 3 years with a view that short-term rates could be a little weaker. Materials continues to grow as a weight, almost a 3 times market weight. Industrials and healthcare, a little bit underweight, but we've got some interesting positions. Staples is underweight. And you can see then we have very low weights in real estate, utilities, communication services, and consumer discretionary. So other signs that we watch: credit spreads, the excess demand return that a bond investor demands to buy a corporate credit continues to fall, tells us that credit conditions continue to be favorable. And in general, we're pretty happy with how things have gone. The market made a low in March and rallied through the end of July. It's when the market broadened beyond just tech. And then we, of course, corrected from July until the end of October, where the market made a turn and has made a run higher. So we've had a couple of tests along the way since then. If we look at the TSX over that period, up 6.8, the equally weighted S&P up 7, the aggregate bond index down 4, the Canadian bond universe down 4, the high dividend payers up 2, commodities up 12, which we talked about through the year, and the long-term US bond down 14. If we take various mixes of our pooled products, we're pretty happy with how things have gone over that period. I don't think that we're behind. I don't think that we're a ton ahead. I think we managed our risk well through the summer drawdown, and we're in a good position to take advantage going forward. We are into a period of time when seasonally, day by day, returns tend to be positive. And we think we're very close to exiting what has been a very tough and grueling 23 months for investors. I put this up last week, and I'll put it up one more time. Volatility continues now to be muted. Historically, when volatility got down to between 12 and 18, you had very significant run-ups in price in stocks. The 1990s, the period from 2003 through 2007, the period from 2012, when the bull market began, through the end of 2015, and so on. So we're into a lower volatility period. There's lots of stuff for us to do. Breadth is definitely improving, and investors are still very defensively positioned. If things start to get more difficult, we're certainly happy to play defense, but it does not appear that that's the case. And so with that, that's kind of our current view. We'll update this every week, and we like having people on. Pam, if there's any questions, certainly happy to jump on and answer them.
Yeah, thanks so much, Dave. One of our loyal viewers, Alejandro, has a quick question for you. He says, Dave, you've been doing a really good job during the calls that you've hosted the past year. He says, thank you so much for that. Now that copper is breaking the bear trend for the past year, do you prefer copper producers over steel producers in this moment? And if you would pick a copper stock, do you think Teck Resources would be a good pick?
Yeah, great question. So, certainly I like both spaces. We own both. In steel, you can buy the SLX, which I put up in the presentation, or you could pick single stock. I think Nucor looks very, very attractive. It's a very efficient producer. STLD Steel Dynamics looks quite good. And Stelco here in Canada. Let me just see if I can share my screen. So there's Steel Dynamics. Let's look at it another way. I've got it here. Okay, so you can see technically really nice base. This is a $18 billion company, trades in the NASDAQ. We take a longer term picture. It's been a really strong performer. It's just consolidated over the last sort of year and a half, and probably looks higher. It's done a great job of growing its dividends. It's got a 1.5% dividend. It's got a 15% dividend growth rate. They're very good stewards of capital, and I think that's not a bad way to go. When it comes to copper, there's a couple of ways to play. So we do own Freeport, and Freeport certainly looks as though it tested its previous low and is trading off it. I'd like to see some relative strength pick up here. In the smaller guys, we own 4N Mining. And 4N Mining is an earlier stage copper company, but technically has been acting great. Really nice pickup and relative strength consistently. There's good value creation going on here. I think Teck Resources looks really attractive. I think that now that they've spun out the coal business, it looks good. Technically it's in an important spot. I put the long-term picture up on Teck B a number of times. But when we look at, let's see if I look at it this way. This is going to be a big cash flow generation machine. So, it's yet to come out of its consolidation range. It's right in the lower end of the range. But again, like the Rio, my guess is when it comes out the top, it's probably going to be, a multi-bag company to own over the period. And again, it's a really well-run company and probably has one of the most interesting new copper developments in the world. So all interesting ways to play it. I don't steel and I don't copper.
Thanks so much, Dave. The next question is from Ron in Regina, Saskatchewan. Love Saskatchewan. Ron wants to know, David, what are your thoughts on lumber stocks at this time? And if you had to choose one particular lumber company, which one would it be?
So as I mentioned, we own Stella Jones. Let me see if I can share my screen here. So there's Interfor, long-term picture on Interfor. It came down to the 150-month moving average and has traded off it. You compare that to wood, which is the forest ETF, which is just coming out of a consolidation. But Stella Jones really has acted so well. It's a specialty product company. But there is no other technical setup like Stella Jones. Now, if you're like me and in your neighborhood, you see the phone company's been replacing all of the telephone, the electric companies replacing all the hydro poles. you can understand they're twice as big, and there's a lot of them. But there's a lot of work being done in the rail yards as well, and there's good pricing on this product. So, the home builders for basic forest products, the home building group has been acting really well. There's the ITB ETF, which is builders and suppliers. I think that's attractive, but we tried to be a little more targeted with the Stella Jones.
Thanks so much, Dave. And for the last question for this evening's program, we've received several questions from people wanting to know, what is the unhedged Japanese ETF that you bought? The most requested information.
Okay, EWJ.
Okay, EWJ, everyone.
Yeah, EWJ is worth taking a look at. The DXJ has been great, but I do think that US dollar weakens a little bit. Japanese policy is probably going to firm a little bit, and the US dollar, Japanese yen can rally. So, not a bad way.
Thanks so
much. I apologize.
David.
I got to run because I got to jump on another call. But thanks for everybody for being with us this week. It's been a long time coming to have a better market like we have, and I think it could be with us for a while. So let's all try and take advantage of it. Thanks so much.
Thanks so much, Dave.